All right, a couple of minutes, and then we'll get started real quick. All right, let's get started, everybody. Thank you all for joining. If at any time before we start you guys have any questions, feel free to put them in the chat box or unmute yourselves so that you can ask the question. I've muted everybody just to start so we don't have any background noise. But again, if you have anything that you want to ask, please feel free just to send me a message and I'll try to get to it as I can. So again, thank you guys for joining. This is the second installment of the Settlement Analyzer training. So I'm going to kind of jump right into it. I think a few of you are repeats and a few of you are new. So we'll go through a quick overview of the entire platform and then be able to do some examples for you guys to get an idea of exactly how to use the software and the capabilities that it has. I'm going to start off by just going here real quick. If anybody wants to walk through the process with me and try this for yourselves while I'm explaining it, I find that helps myself. So if you go to this website, which is setanalyzer.com, you'll be prompted to create an account and you'll be prompted to pay for the services, which are $69 a month. To put that in perspective, it's selling a $20,000 annuity. Which if this sells one large case really does easily pay for itself. But you can put a promo code in there. The promo code is new, and that'll give you a whole month free to try it out. So you don't have to pay anything immediately right now. You'll get 30 days to try this for yourself and see if this is something that may benefit you and may benefit your clients moving forward. So with that in mind, I'm going to keep this here for a second for anybody that wants to go to the website. Again, setanalyzer.com. Go ahead and create your account real quick, and then you can make or add the promo code in there so you don't have to be charged immediately, and then you'll be able to have access to the full range of the account. When you do log in, this is the screen that you will see that it brings you to. This is the home page, if you will. Settlement Analyzer is broken into two main parts. There's a proposal system that's compacted within the software, and then the actual Settlement Analyzer piece that was presented at NASTA for those of you who were able to join us at that time. When you come into this home screen, you'll see across the top, we have 7 different tabs. A few of them you guys won't have. But this first one here is the broker tab. It's very straightforward. All you're going to do is put in your broker information. This information gets put in there because it will appear on the proposals and it will appear on the Settlement Analyzer printout when you print it out. So it's just a way to customize and have your name and your logo and your firm's information on the printouts. This next tab here, which is the claimants tab, this information right here is different cases or claims that you have there. We use that tab to be able to put the claimant's name again on the proposal automatically. It's a really great feature. These tabs here are the proposal creation tabs. For the sake of time today, they're very straightforward. I won't do an example of these today. I think that you guys can all figure it out. You're all very well smart enough to do so. But the basic gist of this is you put in your information on the top part here, similar to what you would put in on QIB or another quoting software. Down below, you'll add your benefits, any type of benefit, your period certain, your lump sums, your life with certains, etc. And then you'll get a printout down here. The first page of your proposal will look similar to this, again, with all of your information for your quote. Your second page will have that very specific annuity benefit that you're offering. Down here is a disclaimer that you can customize yourself. And the last page is going to have a chart of your benefits. Obviously, this one's only has one benefit, so it's not as pretty. But when you have multiple ones in there, it makes it a lot easier to understand exactly when those benefits will be given to the claimant. So adding a bit of a virtual or a visual representation can be very beneficial if you don't already have a system to use. So that is what I want to consider kind of a cherry on top of the program if you get into it. I know I'm speeding by that part. We can come back to it if people have specific questions on it afterwards. But I know most of you are here to get into the actual settlement analyzer piece. So I don't want to hold you guys there any longer. So if you click on this tab, which is the Settlement Analyzer tab, it'll bring you into this initial screen. In order to utilize the tab, you need to be able to have a couple things done before you come here. You'll have to have completed your broker information. Once it's completed, you'll see it populate down here. And you'll need to have added a claimant, and you'll see it populate down there. So you would go into this first box. We're going to work top to bottom and left to right. You'd select yourself, and you'll select whatever claimant is applicable. In this example, I'm just going to say that we're going to work with a 12-year-old for a couple of examples that we're going to do here. You want to select those first. Next, we're going to drop down and go left to right. This first left box on the orange side is our parameters. And what I want to explain to you before we get into the specifics of what to input is the general idea behind this software. So this software grew in 2019 out of a general idea to understand why structures are better in certain circumstances than an investment portfolio. So this started from just a simple Excel sheet that did a single iteration for a very defined period of time. What we were trying to understand is when we factor in taxes, money management fees, and market volatility, all factors that a qualified structured settlement are immune to, how it compares to an investment portfolio. And what we found in this process, at least in the initial stages, is that when we did factor in those components of taxes, management fees, and market volatility, that a structure was extremely strong. And that was even back in the beginning stages of COVID when rates were going in a not great direction for all of us here. So what we did is we wanted to expand it. So we invested with an independent firm to create the software that you guys are looking at here. And we really want to answer one specific question when we're doing this analysis. We're asking ourselves, at the end of the duration that we've chosen, which is this box right here, this numbers of years box, at the end of this duration, does that investment portfolio that we're setting up to compare to the structure have money in it at the end? Yes or no? If it has money in the portfolio after the duration that we've set, then we're going to call it a success. We'll say that that portfolio was better in that circumstance than a structure. If, however, at the end of the duration, that account is at zero or less than zero, we're going to say it failed. And we're going to say that structure was better than the investment portfolio. So before I jump into actual numbers, does anybody have any specific questions for me right now? I'll take silence as a good thing. Okay. So I'm going to jump into this first example here for you guys. And again, at any time, please stop me. I will do my best to explain it. I know I talk fast at times, so I'm trying to slow down. But if anything comes up, please, again, feel free to shoot some messages in the box. So we're going to start with this left orange box here. The start year is the year in which that money is going to be invested. So 99 out of 100 times that's going to be this year. So we're going to leave that as 2022, and that's going to be your default. Our numbers of years, as I touched on earlier, is the duration at which this account has to last. So if we're talking about a young individual, in this case, we're dealing with a 12-year-old. In this scenario, this account has to last 50, 55, 60, 65 years at a minimum for this individual if we're not taking into account any type of rated age. So numbers of years is important, again, just to be able to set the parameters for how long we expect this person to live. Another way to look at it is life expectancy. How long do we expect this 12-year-old to live in additional years? For the first example that I'm going to do, I'm going to say 60 years. So that would make them up to 72, which is a pretty fair or biased, if you way of saying the model portfolio only has to last 60 years. In a realistic sense, there's a really high chance that it would need to last longer. But we'll be conservative to start off with the blocks here. Next is the taxable button. The taxable button is only selected for non-qualified cases. And we'll do an example. Our third example today is a non-qualified cases or case, but I'll show you how that works. But for now, for a qualified case, leave that taxable unselected. Our start balance is the amount of money that we have to take and invest somewhere, whether into a structure or into a model portfolio. In the specific example that we're going to work with today, and all of these factors are arbitrary. It's not based off of any type of specific example. These are all arbitrary numbers that I created this morning just for you guys. So in this instance, we're going to say we have $2 million to invest. So after their settlement, after attorney fees, after liens, et cetera, they have $2 million to look to invest somewhere. Next, we can select every state in the US that we would want to. So we can base it off of any state. We have to factor in when there is interest gained on these accounts that it will be taxed at both the federal and state level. So in this example I did this morning, I did Florida, which is no state income tax, again, being extremely conservative for this portfolio. Moving down to the bottom, this is where we get into a little more of the specifics of how the account is going to function. So the first one here is percent bonds. So as most of you know, in a typical model portfolio, your investments are split between a stock and a bond investment. So for Settlement Analyzer, right now, the way that our stock piece works is it's connected to the S&P 500 index, plus reinvested dividends. So most stocks can give you a dividend, you can reinvest that. So it actually makes your gain 1 to 3% higher on any given year. So that is built into the back end. You cannot currently change that stock piece. We are, hopefully with enough support from the folks on the call today, should be able to build in more of those stock pieces so that you can choose from either the Dow Jones, the S&P 500 index, another specific index that might be of value. But right now, currently, we're looking at the S&P 500 index. For percent bonds here, you can do anything from 0%, which means the investment would be 100% in stocks, or you could do 100% bonds, which means there would be no stock value at all, and it would only increase by the bond rate that we can input next. For our example, in all intents and purposes, a 60-40 split between stocks and bonds is fairly common. So we'll go ahead and here and put 40% for bonds. When you put in 40%, the system will automatically know that another 60% is allocated towards the stock part, which is that S&P 500 index. Bond rate is something that you can manually input. So this is going to be based off of current rates. The 10-year treasury is somewhere around 3% right now. There are a couple bonds that you can buy that are just slightly higher than that. There's some research that you can do outside of the system to get an applicable bond rate that will be of most benefit. But for this scenario, I'm going to put 4%. And I'm going to put 4% because, again, we really want to have a conservative model put forth so that when this gets in the hands of a claimant, plaintiff attorney, an investment advisor, a financial analyst, our platform as independent and as conservative as it can be, so that there is no pushback, there are no arguments that we're being biased in any manner, but rather we're trying to be independent and really look out for the best interests of the claimant. So we'll put 4% in here. And again, that's a fairly generous bond rate given current 10-year or even 30-year treasury rates. The next one here, this next box is runs, and this is our iteration. So what we're doing in this analysis is essentially a Monte Carlo analysis, which means we're going to run all of these parameters in one scenario and output a yes or no. And again, that yes or no is, does that account have money left over after in this case, the 60-year duration that we want it to run? So we'll do that 100 times on an individual basis. And I will show you guys in just a minute the outputs of that in every single line of data, should you want to go into a specific run and a specific year within that run to see exactly what might have happened or to get some more information. So I would advise you to leave this at 100 runs. It gives a very fair picture of the potential outcomes of this case. Last box for an input right now on the left side is our fees. And this is our money management fees. So these are the fees that a financial advisor is going to charge to manage this portfolio on behalf of the claimant or the family. This can range from anywhere from 1 to 2.5%. It's based on the investments and it's based on the company that is actually doing the investing. It has an inverse relationship to the size of the account. So the larger the account, the lower the fee percentage, and the lower the account, the higher the fee percentage. Most companies may change this fee percentage over time. As your account balance becomes lower, they'll actually charge a higher fee because they want to make more money out of the account because there's less value in it. But this management fee is taken out annually from the portfolio. So it's very important to factor this in and not forget that it exists. This is commonly overlooked when money goes to cash and then money goes right to a financial advisor. They don't realize the amount of fees and the amount of taxes and the volatility that is subject to these cases. So I'm going to use a 1% fee that's on very much the low end. Again, very, very conservative. It could be higher. But again, we're building an output here that cannot be contested for being biased. We are being as conservative as we can be in these calculations. And I think that gives us a seat at the table without being shooed away as being biased. This box here labeled filing status is just that. It's your tax filing status on your federal level. So you have your federal brackets, you have your long-term capital gains only brackets, and you have what we're calling hybrid, which is actually a combination of both federal and long-term capital gains. Just as an investment portfolio has stocks and bonds, they get taxed at different levels depending on how long you keep those assets. So the hybrid tax bracket allows for taxation of both a federal and a long-term capital gain rate, which is the most accurate way that we can put this forward. So for this scenario, we're saying it's a 12-year-old, they simply are not married. We're going to utilize a hybrid single tax bracket. You'll notice now that we're done with our left box, we can come over to our right box. Our right box here is for our annuity. So remember, the left box was based off of creating this model portfolio. And this right box is going to be for our annuity benefit. And I did this a couple weeks ago for the last training, and I just did a straight annuity benefit, a straight life and 40. Today, I wanted to show how we can factor in a COLA to this as well. So I went on to a life company's quoting software this morning, used a 12-year-old male, no rated age, and said, what does $2 million buy me for a life and 40 with a 2% COLA? What that returned on an annual basis, because the draws on this right side are an annual basis, it makes the calculation significantly easier on the software. Again, with enough support, we might be able to build this out on a monthly basis, but for now, it's on an annual basis and works very well in that way. But so what I found out was that for $2 million with a life and 40 of a 12-year-old male and a 2% COLA, it yielded $52,452 as a starting monthly benefit for that first year. So that's what you'll put in for your first benefit year. So this is the amount of money they're going to receive in that first year. Then we have our COLA box, straightforward at the 2% COLA. And our start year and our end year are going to typically be in a life contingent matter already preset for you. You'll notice the software calculates the end year to be 60 years after the first year. So we don't have to make any adjustments there. We just hit draw, and then you'll see it populate down here at the bottom. And that's how you know it's added to the system there. So once we've added our draw, which is our annuity benefits, once we've added all of this information on our left to model the portfolio that we're comparing between the two, our blue button down here pops up, Start Analyzer, Run. So what you do, it's very, very simple. You click the button, and now I'm going to scroll down and just show you guys the results of this run. So this is the first run. All of the inputs that we just did will show up on this left side. If you click your blue button, you'll see that the draw is populated there. And all of the inputs that we just put show up in our blue box here on the left side. On the right side, very straightforward. We want the color coding system. Green is good and red is bad. So the green ones are our passing runs. And again, that definition of passing is that in the 60th year of this account that we're making, this arbitrary account, there was still money left over after it paid all of the management fees, taxes, and the draw that was going to be taken out that year. So it still had money left over. But you'll notice the average final balance in the account was about $400,000. So in our average years of the ones that passed, of the 20 that passed, which is not a high percentage out of 100. Of the 20 that passed, the average final balance at the end of the 60 years was just over $400,000. And the average taxes that they paid over those 60 years is $1.6 million in taxes alone. Moving to the right in our failing column, we failed almost 80% of the time. Even in the failing runs, we paid on an average $1 million in tax. And what I really want to point out to you guys, and when you use this software, I want you to point it out to the people you present it to. This is extremely important. The average year the balance ran out. So of the failing runs, the average year in which it ran out was 2074. For a comparison, we wanted to say it had to run to at least 2081. So it ran out on average 7 years early. Again, in other words, so it only lasted on average 53 years, which makes that person 65 years old on average. They still have at least 20 years of life left to live, hopefully, especially with mortality continuing to increase. Extremely important to point out. Moving down to the next, just a general graph to give a little bit more insight. Blue one you'll notice is our quote unquote best run. Our green run was our median run. That was our average. And yellow is worst case scenario. Yellow is if the market goes essentially really, really bad, which all of us on the call today know that the market right now is not doing well. And we need to understand and be able to show people, rather than just say a structure is better, but actually be able to show people why a structure is better. With the basic graph there, you can interact with any of these points to see the balance at any particular year. Continuing with the graph, just another simple one. If there's more red than green, there's a lot of questions to be asked about, is this the right investment model? In this case, I think that there's a really great argument for the structure broker to be able to take that $2 million and put it into a guaranteed annuity with increasing rate of returns as we have now, and a guaranteed COLA, which I'll show you in just a minute how much that actually increases, to be able to provide for this first person for life. And remember, we're only running this for 60 years. There was a question in the chat to me about how is mortality calculated. You get to input your mortality however you'd like to input. You can base it off of life care plans that you have, maybe rated ages that you're receiving. I'm using 60 years as a ballpark figure. You can create the mortality however you'd like. But remember, we're only running this for 60 years again. So we're only running this till this person is 72. And it's still running out early most of the time. Think about that for a second. Coming down here, I told you and promised you earlier that you could see all 100 runs and every piece of data that you'd want to see with it. Here it is. Open platform. We have 100 runs and all of the data that you could want to see. If you click on the yellow view button, run 26 as it's labeled was our best run, if you recall. It was this blue one. You'll see the 26 next to it. You can click view and open up all of the data you want to see. You want to understand how it's calculated, how it works, etc. What I want to pull your attention to is this draw. We added that 2% COLA in there. Over 60 years, it's substantial what it draws to. We started at around $50,000 annually. At 60 years, we've more than tripled the amount of money that annuity is guaranteed to pay for this person. Guaranteed. Not hoping, not projected. Guaranteed to pay this person. Investment portfolios simply cannot keep up with that when you have to factor in market volatility. This random gain column, this is our S&P 500 index. That is really the engine of the software here. This is the random generator that you're seeing. And you'll notice why this run really is the best run. If you look at this stretch here, the first X amount of years, we only have one negative year and a whole lot of really substantially big growth years, which is terrific if that was really how the market worked. Unfortunately, it doesn't always work like that. But I wanted to point this out to you guys to show you just how this really works, all of the data that you can gather. There's more columns in here that you can select. We only have selected a few just to make the visual representation of it easier. But you can get down to every little detail that can bat arguments from financial advisors that somehow they may be able to protect a claimant's interest in financial benefits better than we can somehow. It simply will not work. And the last piece I'm going to show you on this particular example, if you go right up to the top, right below our blue settlement analyzer button, you have a view PDF button. So the view HTML was what we just went through. The view PDF button is the printout that you can physically hand to somebody and say, before you kick us away from the table, before you take that money and run somewhere else, please look at this, read this, and let me explain it to you. Our first page is very, very simple. You'll have your company's logo up here, you'll have the claimant's name down here, and you'll have your name down here, all customized again from this broker's tab. Our second page is an analysis, a breakdown in paragraph form of just what we did, how we did it, how it works, just so if you guys don't have the opportunity to physically be in the room presenting this, at least have an idea of the analysis that was done. Just walks through that we did a Monte Carlo analysis, the duration, what was linked to, the fees that are involved, etc. You guys can read it. The third page is simple. The third page is the results that we saw on the HTML side a second ago. On the box on the left, it's all of our conditions. And on the outcomes, just a breakdown of our passing and failing. It's black and white there for you. And then we put a snapshot of the graph in here again for best, middle, and worst runs. And the last page, should somebody really want it, is some information on every individual run. Again, we have all of the data. We're presenting all of the data immediately. Again, what I want to point out is two things. One, we're going to add a total management fee column in here so they can see just how much their financial advisor, who may be their best friend, is actually going to be paid over the duration of this account. And then also the total taxes that they're going to be paying on this account. I think when people see the amount of money that they're having to pay Uncle Sam at the end of the day, it may change how they feel about how they're investing their money. And again, just to point out that management fee, it's right here. You'll notice we did again 1% every single year, whether it goes up, down, sideways. They're taking out substantial sums of money from this account every single year, every single year. There was a question in the chat just now about the design of this printout. Right now, this is the standard design. We will work with you guys, hopefully with, again, enough support to be able to customize this in any way. If you want to remove the background, change it around a little bit, we can make that happen for you guys. So we'll make a couple different designs of this. But as you're all well aware, software is not inexpensive, so we need additional support to make this really something that you guys absolutely love, and that's the goal, is to grow the industry with these types of analyses. So, and Tim Morbach in the chat points out a couple really interesting facts as well. Large managed accounts also have a substantial tax burden and an extra fee that we don't even factor in here. And that summary does self-populate itself. Tim, if you are if you're asking about this one on the second page, yes, it does. It populates the 2 million, Florida, our filing status, when it begins, runs, etc. So it does all populate itself. So that's the first one. I know that was a little bit long. I know it's a ton of information and new to a lot of people. Again, the overall goal of this is to be able to show that structures are better, not just say that structures are better. Being able to get our seats back at the table and show the value and the analysis that we've done rather than being a commodity where some of us find ourselves now, we can grow this industry 2-3 times what it is, and really be able to help more people avoid having future financial difficulties because they thought something was great and it turned out not to be. There's another question to me. The S&P 500 is randomized. That's really the engine, like I said, but the bond rate is not randomized. It is set there so you can pick any bond rate that you'd like to do. What we would like to be able to do in future iterations is be able to change maybe the bond rate in 20 years. We want to have it at a different level. In this scenario, we want to say, okay, this person may get married. So in 30 years, let's change it from a hybrid single to a hybrid married tax bracket, which should reduce their taxes just slightly. So there's some, again, changes that we would love to make. Right now it works, fantastically, but we can get into more detail and more accurate analysis if we have continued support. So that was the first example. The next example I'm going to go into is slightly different. So what I'll do is I'll just remove my draw and I'll show you guys how easy it is just to run a whole nother scenario here. So we're going to run another scenario. We're just going to say it's a slightly older person. And for whatever reason, what we're going to decide to do is we're going to do a 20-year period certain with 3 lump sums on top of it. What we want to look to do is we're going to run a period certain for 20 years, and we're going to put a lump sum the year after it finishes. So it's 20 years plus the lump sum year. So the duration is 21 years. This, again, is not going to be a taxable event. It's a qualified settlement. We have, in this scenario, $500,000 that we're going to invest. And I said, in this case, this person lives in Georgia. Same principle going forward. Perhaps this couple is going to be a little more aggressive. So they're going to put 70% into stocks and only 30% into bonds. We'll keep our number of runs and iterations the same, our bond rate the same, and we'll say our management fees are the same as well. We will change it to a hybrid married tax bracket because we're going to, again, assume that this individual is married. Over to our draw column. I'm going to show you guys how this works out. So what I did is I took $500,000. I went and bought $2,000 a month or $24,000 a year for 20 years, which, if you do the math on it, actually runs through 2041. Again, so that's the 20 years. 2042 is that last year where that last lump sum is going to come into play. So we have that for the first 20 years, $24,000 a year coming out of that account. Then we have $100,000 as a lump sum payable in 2032. And the way that you put in lump sums is your start and end year are identical. That's how you put in a lump sum. 5 years later, they're going to receive a $125,000 lump sum in 2037. And finally, we had money left over to buy a $155,000 lump sum in 2042, that final year of the analysis. So you'll notice you can put in multiple draws just like that. Now we have all of our parameters in place here. We'll hit our start analyzer run, and you'll notice down here, run 2 populates. So run 2 is our second run that we just did. And now we have our box again on our left that has all of the parameters that we entered, and our box on the right, our passing and our failing runs, very simply. So in this scenario, 30% of the time, this investment portfolio that we set up above outperforms the structure. And what you'll notice in these graphs is really when there's a dip in the account balance, and that's when the lump sums happen. So it's this bar right here, and then this bar right here, and then you'll see a lot of them fail at the very last balance of $155,000 needing to be taken out of that account, and it simply does not have $155,000 in that account. The same graphs down here, and again, the same data. What you'll notice as you scroll through here is some of these didn't make it by much. Some of the passing runs did not make it by much, and then some of the failing runs did not make it by much at all. And again, you can go and you can view the PDF, and you have all of your analysis in here, automatically populated with your general outcomes and additional data to present to the client. The last one I'm going to do, as promised, is that non-qualified case, to show you guys that this also works for non-qualified cases, whether it's attorney fees, wrongful imprisonment, etc., environmental. You can use it for those types of cases. So we'll go up here, and we'll say in this case, maybe it's a 60-year-old attorney. For those of you who were on the call last week, this is going to be a very similar example. So we're going to say it runs for 10 years. We're going to start it immediately. So we'll delete all of our draws out of there. We don't want anything over here. So we have a 10-year attorney fee structure. This is where we're going to hit our taxable button. What that's going to do is take the initial investment amount and reduce it to net terms. As you guys know, all of the money has to be taxed in that case. So what the attorney would be faced with is taking that $500,000, which is what we're going to use here, attorney fee, and they would have to take the net amount of that and then invest it thereafter. They can't, invest the $500,000 deferred unless they structure it with us, which is again what they really should be doing, and that's what we're trying to set here to prove. So we're having a $500,000 investment. That's what their fee was. And this example that I used, I said it was in Texas. In this case, the attorney's also maybe a little more aggressive, is going to go more towards the stock market. 4% bond rate, I think that's consistent for right now. 100 runs should be very standard, and a 1% fee is on the conservative side. As I mentioned earlier, investment size account has that inverse proportion, so it very well could be that the fees are 1.5 or 1%. But I'll show you guys the difference between a 1 and a 1.5% fee in just a moment. Over on the right-hand side, I went to market again and said, what can I get as a $500,000 non-qual 10-year period certain? Came out as $56,000 a year. You'll notice again, the numbers are already adjusted for you based off of your duration. You click draw, pops down for you. Now you're ready to click your start run, and run 3 is populated. You can scroll down your conditions. What I want you guys to pay attention to is this start balance right here. So that's your net amount of money in Texas. So after you're paying your state and federal taxes in any state, there are obviously some that don't have a state tax, which is fantastic. But that's what the ad attorney would have to start their investment portfolio with. And then again, our passing and failing runs. All of our graphs that are a little less volatile because they're only a 10-year versus multiple years. And you'll notice in here, the draw is also taxed to all be net values within the software. So here's all of our inputs. Some of them are successful and some of them are not successful, but here's all of the data for you to be able to utilize. So we're at around a 40-60 split I want to show you guys how you can change things and make them really, really easy. If we wanted to change the management fees to 1.5%, we can go ahead and do that, hit our start button, and you'll see it changes it just a little bit. Short duration won't change it drastically, but maybe they don't live in Texas anymore. They move to the fair state of California where taxes are higher. Well, now we have a little bit different story. So now they're paying California income tax. Their start balance is going to be lower because they have to get taxed more in California, obviously, than in Texas. And they're going to be taxed higher on the interest that they're gaining from that portfolio. So now instead of almost a 40% success rate, they're half of that. They're around 20% success rate that portfolio would outperform a 10-year deferral. For those of you who might be interested in factoring additional income, that attorney maybe isn't done working yet, and their annuity is going to be factored off by additional income that they may still be receiving. So we'll say that they're projected to get $250,000 over the next 10 years. That's their average income. You can factor that in as well. And now with additional income, which is going to put their tax brackets into higher levels, into both California because it's bracketed and the federal system, now we're looking at even less successful scenarios. Because again, the more income you have, the higher it's going to push the annuity or the interest gained on the investment portfolio into those higher tax brackets. And just as the other ones, you'll have your PDF printed out here and your analysis. You'll show all of the same factors in here, automatically inputs everything. It changes this from tax-free to tax-deferred, so there's a few different language pieces when you get into non-qualified. But again, the same outputs and same data types. So that's where I'm going to stop for today. We have only about 10 minutes left. So I know that was a whole lot of information. There's a lot to learn in the system and a lot by testing it yourselves. So again, to go back to this page, I implore you guys all on the call and all of your colleagues to go create your account, use the promo code, get it free for a month, test it out for yourselves. If you don't like it, I'd love feedback. We want to make this something that really changes the industry and is allowing everybody to do better in the industry and really look out for the claimants and avoid cases being cashed out as they, are so often, especially these days. We're at a really good place right now with the market showing its volatile side and our interest rates rising, which makes Settlement Analyzer even more valuable. And even if the scenario that you present in the PDF printout isn't the structure that's chosen, at least it may get you a seat back at the table to look at options. So maybe look at alternative products, look at a GSS or an ILAPA or an EARLS, etc. Get your seat back at the table and show both parties that you're not just a commodity or an aftermarket thought, but somebody who's actually looking at this case as an individual standard and cares about the outcome of the case entirely. So I implore everybody to go to the website, use the promo code, learn how it works, mess around with it, send me an email when something comes up that you have a question, would like it changed, would like a specific one-on-one training. I'm happy to do that for everybody. So I'm going to be quiet for a minute. If anybody has a question, please unmute yourselves. I did mute everybody to start, so please unmute yourself, ask the question. If you want to ask it directly in chat or email me, you can do that as well. So I will sit here for a few minutes and see if anything comes through. But I want to thank all of you guys for joining today to go through this. We'll set up a third round of these in the next 1 or 2 weeks just to keep the momentum and training going. But please feel free to look at this and use this and just see how it can really change your practice, especially when you have an opportunity to present information. So with that, if there's any questions, I will take them. If not, please feel free to jump off and thank you again. This was recorded, So we'll download both the first and second trainings and send those out to everybody who participated. Perfect. And yes, I agree, Tim. I think judges do love this. And you're welcome, Frank. Okay. Perfect. Well, again, thank you guys so much for joining this. I look forward to hearing really good stories about how successful it was. If there's anything that I can do to explain more, answer questions, provide specific examples, or even do a one-on-one training with you or any of your colleagues, I'm happy to do so. Just send me an email. I appreciate it. I'm going to jump off now, but again, reach out if you have any questions, and thank you guys all again for joining today. Have a good one.